Welcome to our taking stock video for the week ending the 11th of October 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your Think Share Markets. How are you today, Jace?
Very good, Ken. Thanks for having me again.
Great to have you on board on a lovely sunny day today. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures shown today shouldn't be relied upon as a guide for future performance. Firstly, I just want to thank you to all our members who joined our online masterclass event yesterday. We hope you all enjoyed the day. Tim and the Lincoln team, we were there to share our passion and knowledge, and we hope it all came through. Also, a recording will also be sent out so you can catch up on anything you've missed. Well, to the markets, Jace, it's been mostly positive on equity markets with the initial momentum driven by positive US economic data we saw early in the week. Firstly, there was that better than expected US jobs report, which revealed a drop in the unemployment rate to around 4.1%. And also that increased the prospect that the US economy would be in for a soft landing here.
Yeah, it is really interesting what's happening right now, Ken. And this came on the back of a rally in resource stocks last week after China revealed a round of stimulus measures, including interest rate cuts and also property funding as well. However, the devil is always in the details, Ken. And over the week, Chinese officials failed to deliver on those expectations, indicating that they're mainly helping small to medium-sized businesses in soaking up excess property stock. So this set the market a little bit upset in regards to what type of stimulus measures they were about to boost in their economy. But also in addition as well, Ken, the World Bank announced that they expect China's economic growth to deteriorate next year. And this is despite the recent stimulus measures. So not surprisingly, we saw a retracement across most resource stocks, including BHP, Rio Tinto over the past week.
That's right, Jace. But defying the price weakness within resources, we had lithium stocks like Mineral Resources and Pilbara Minerals. They fared better on the back of M&A activity. We had borderline star growth stock Rio Tinto. They announced that they agreed to buy Arcadium Lithium at a price of $5.85 US dollars per share, which translates roughly to around $8.20 Australian dollars per share, a 90% premium to their closing price at the end of last week. And the bid has made investors reassess the inherent value across all these lithium stocks, especially following the 80% decline in lithium prices over the last year. But we'll provide more detail about this deal later in the episode.
And also the volatility among resource stocks reminds us to stay vigilant within our portfolios as well. We need to really focus on risk management, and this is to ensure that you maintain a well-diversified portfolio of at least 15 securities. And hopefully most of them are high quality stocks as well. And despite the volatility across this resource sector, the key risk for markets is potentially the escalating conflict over in the Middle East. The biggest concern here for us is whether a potential strike on Iran's energy infrastructure could hinder the oil supply and potentially lead to higher oil prices. And this in turn could keep inflation higher for longer and potentially derail the soft landing narrative that the market has on right now.
Yeah, that's right, Jace. Risk management is so important right now. And you talked about inflation data being sticky. Well, US data came out this week also showing underlying inflation holding up and rising as well. So we just got to watch that as well. Remember to take profits on stocks that have rallied quite strongly. And speaking about share price performance, the strong performance across some of those lithium stocks, let's turn our attention to another stock that's really had a very strong price rally. Star growth stock Netwealth, NWL is the code here. Now, Netwealth is a leading Australian financial services company providing that innovative platform solution for superannuation investment and managed accounts. Their latest trading update shows continued growth in funds under administration, and that's driven by new customer inflows and also this strong market condition that we've been talking about and the level of funds under administration. They appear to have beaten market expectations here. So, Jace, will this momentum last, and how might this affect their earnings outlook?
Well, that's the big question, Ken, with the projections on higher return on equity into FY25 at around 66%. The update should also potentially promote earnings upgrades to FY25 estimates which is currently covered by 14 analysts. Remember, this business is riding the tide of strong performing equity markets, and equity markets could change at the drop of a dime. So this is something that we need to take into consideration. So prudent profit taking should really be considered, especially if you are overweight this stock in your portfolio.
Yeah, I also notice this is another business which is founder-led with father and son Michael and Matthew Hines continuing to hold a significant stake in the business, close to around 50%, with most of that holding through a family trust. Let's now turn our attention to APA Group. APA is one of Australia's largest infrastructure businesses, specialising in natural gas pipelines. They operate over 15,000 kilometres of pipelines across the country, delivering gas from production areas to cities and industries. Recently, the Australian energy regulator, they decided not to impose tougher price regulations on APA's critical gas pipeline from Queensland to the south. So, Jace, what does this mean for APA's outlook?
Well, the decision came as a big relief for APA. I mean, avoiding stricter pricing regulation on one of their key pipelines means the company can retain more flexibility in managing its revenues from these assets, which is crucial for maintaining their profitability. More importantly, from an investor's point of view, this helps solidify the sustainability of the company's dividends at pretty close to 8%. And this is often seen as one of the company's biggest attractions. With longer-term contracts and well-regulated assets, the company remains a reliable dividend payer in what is looking like a very turbulent energy market.
Yeah, with share prices well below their highs for APA, potentially that could represent an opportunity for investors. But
Mm.
looking at the week ahead, the AGM season is now underway, and we expect to see a few trading updates from our star stocks. IDP Education, we've got Telstra, we've got Redox, ArbCorp, PWH Holdings, and also RPM Global. Two of the most interesting ones here will be IDP Education, which has been facing diminishing student numbers, and also PWH Holdings, which has missed earnings expectations when they reported last August. In Under the Microscope this week, we take a closer look at Rio Tinto's latest move, its bid for Arcadium Lithium. Now, Rio is one of the world's largest mining companies with a diversified portfolio spanning iron ore, aluminium, and also copper. But this bid is really all about lithium. So, Jace, what's the rationale behind this deal?
Well, Rio Tinto is really looking to secure a stronger foothold in the lithium market, which has been crucial for electric vehicles and the renewable energy storage thematic. The company is also seeking to diversify beyond its primarily products of iron ore, copper, and also aluminum as well, Kien. Previously, the company did try to build its lithium business from the ground up in Serbia, but this was rather unsuccessful. So the acquisition will allow the company to achieve immediate scale in production. Now, if you can recall, Kian, Arcadium was formed following the merger of ex-Star growth stock and lithium miner Alkene, and also chemical manufacturing company Livent. So Arcadium is a global, fast-growing and vertically integrated lithium chemicals producer with an asset base that has a long life, low cost, and also great portfolio of growth projects.
It looks like quite an attractive company there, Jace, but we also need to be mindful that Arcadium is currently free cash flow negative, and that's due to the low lithium prices at the moment. As a result, it is struggling to fund its growth projects. So the benefit of this deal is that Rio Tinto will be able to help fund its growth pipeline and extract some value from there as well. But at an offer price of around $5.85 US dollars, it doesn't appear to be too cheap here, despite the opportunistic timing of this deal. So how might this impact Rio's financials here?
Yeah, Arcadium shareholders have definitely had better days since the share price hasn't really gone anywhere. It's mostly gone south as well. The company is currently valued at $10 billion in terms of valuation. And when you compare this to Rio Tinto's market capitalization of $195 billion, the deal is roughly 5% of Rio's total market cap. So we don't think it's going to have a material change on the financial health of Rio's overall business, even if the company takes on more debt to fund this acquisition. I feel like the biggest issue for Rio Tinto is whether they'll be able to extract any synergies and also accelerate the pipeline of Arcadium's growth projects, which could take longer than 3 to 5 years to realize.
Yeah, very interesting there, Jace. But at the end of the day, the biggest risk here is the lithium price and whether they've bottomed. Many analysts do suggest that lithium prices are close to the bottom at these levels. However, Rio Tinto, they're looking at the longer term and they expect demand for lithium to rise in the next decade ahead, especially with the importance of EVs and also large batteries that can store electricity and release into the grid when consumption surges. And the US has also designated that lithium is a critical mineral. With resources in the spotlight this week on the back of M&A activity and also China stimulus, a useful question is, what are the key factors you should look for when considering investing in a resources company, Jace?
Yeah, very timely question, Kien. Unlike industrial companies, resource companies are cyclical businesses, and this means that they rise and fall in tandem with the commodity price cycle. And with the global economic cycle in the contraction phase right now, there is significant uncertainty in regards to the outlook for resource stocks. This is typically reflected in the large negative earnings revisions across stocks like BHP and also Rio Tinto.
Yeah, that's an interesting factor, Jason. It's quite useful that 3-month earnings revisions, which captures the recent earnings drivers, including commodity price movements and to a lesser extent, changes to production volume expectations. So really, it's about you having faith in the long-term demand for that underlying commodity price and whether you believe that commodity price will continue to rise over the long term.
That's right, Ken. And resource companies also have significant capital expenditure programs, and this is via exploration activities, etc. So it's also important to look at this and also to look at the return on investor capital, because this would determine its efficiencies in terms of allocating shareholder capital to generate earnings. However, this metric under Golden Rule 3 can change substantially depending on movements in the underlying commodity price, like what you said before, Ken. So take, for example, the earnings revisions for mineral resources.
Yeah, so I guess from a resources perspective, Jace, a qualitative assessment is quite important. Drilling into that annual report, for instance, under Golden Rule 8, you'll be able to extract useful information, including the quality of assets, such as the level of reserves, you've got the mine life, check out the resources grade, which can lead to lower cost of production as well. In addition, it's also important to understand the capital investments, as you suggested, Jason, assess the geographic exposure. For example, we've got Perseus Mining, which is our gold stock there, which has assets across Africa.
And also, last but not least, the financial health of a business is pretty crucial to help you avoid speculative investments. And this is especially true in terms of the current market environment where high debt costs and also softening commodity prices can really add volatility to earnings. The majority of resource companies are speculative exploration companies, and typically they don't have any cash flow and rely on capital raisings just to survive.
Yeah, so be careful there. And at the portfolio level, it's important you are not overly exposed to resources stocks, which can be volatile and unpredictable in the short to medium term. As a proxy, though, resources represent about 25% of the All Ords index. So you don't want to have anything above that level due to concentration risks. That's all we have time for today, Jace. And thanks again for your contributions. Very insightful.
Thanks, Ken. It's always a pleasure to be on.
Pleasure to have you on board. And just a reminder of the additional services we have. We've got that Platinum Stock Doctor community. So if you haven't already joined up, feel free to. It's about sharing ideas, meeting key investment professionals and attending premier events, and also having your portfolio holdings analyzed. Also, if you find Stock Doctor useful, why not refer us to your family and friends? As an added bonus, you also have the chance to win a luxury winery experience at the Penfolds McGill's Estate in South Australia. In the meantime, take care and have a happy, healthy, and prosperous week ahead.